Welcome to Growth Investing Mastery. Today's video is going to be about selling or trimming a growth stock. I was recently talking with an experienced investor whose opinion I respect a lot. They mentioned their process to buy stocks is solid, but they struggle with decisions of when to sell or when to trim. And we'll look at some theory behind selling or trimming, and I'll also provide real-world examples of when I sold or trimmed a growth stock. As a reminder, this is not investment advice or recommendations to buy any stocks. Let's think about the choices we have as an investor who's investing long or just buying and selling stocks as opposed to doing margin or options. We can buy into a new position or we can add to a position. And additionally, we can sell a position or trim an existing position. Almost all the articles or financial media on stocks focuses on number one or starting a position. And there's not that much great information out there on when to sell or when to trim a company. And when someone looks up, how do I know when to sell a stock? There's a lot of cliches in the financial media. For example, they might say, let your winners run, or you can't go broke taking a profit. Another one you may hear is cut your losses short. And there can be a lot of contradictory information within these catchphrases. So let's do a little bit of a deeper dive on this discussion. I want to introduce the concept of a sample portfolio. Here we own 10 stocks, and company A, or our highest confidence position, is 20% of our portfolio. And we have a couple other high confidence positions, B and C, which make up 18 and 17%. And there's a few companies in the middle or medium confidence positions. We also have companies at the bottom, like companies I and J, which make up just 1% of our portfolio. And the reason I'm bringing up this sample portfolio is the decision to sell or trim may depend heavily on what our allocation is. For example, if company J disappoints us and it's only 1%, we'll probably just sell it. There's not a lot of point to trimming and making this a 0.5% position, and it's fairly easy to reallocate a 1% position and just put that money into one of our other top conviction positions. On the other hand, if company A disappoints us and we decide to sell, then we have to reallocate 20% of our portfolio, which is a lot, and that may require careful thought. First, let's look at reasons we may want to trim a company. A good one is that our allocation has gotten too high. And typically, I don't like to have over a 20% position in a company. And if it gets up to 25%, I'll almost definitely trim. Sometimes a company will have a large green bar up, or the company will just gap up for no reason. And if we were already thinking about trimming this company, this can be a really good reason to trim because the price just shot up higher. Other times, our enthusiasm for another company may be higher, and we need to look for a company to trim. Sometimes a company may have a big run up on no news, and this can occur over a period of weeks where a company just keeps going up every day inexplicably. This is a good reason to trim potentially. One more reason to trim is if our confidence level is lowered, and this may include a lot of categories and is pretty generic, but our confidence can be lowered for a variety of reasons. We can use trimming as a tool to make standard reallocations and get closer to the target we want for an allocation on a company. We may trim if we aren't completely sure about selling yet and are still on the fence about what to do. Sometimes we may become inexplicably nervous holding a company, and that can be a good reason to trim while we learn more about what the signal is. There's also potential bear cases which may come up. Either somebody tells us or we see an article, but we aren't fully convinced yet. We may want to trim in the meantime while we learn more. Let's have a look at what some of the advantages are with trimming a stock over selling it. One of the main ones is that we do not need to make all or nothing decisions. We can trim and then see how we feel about our resulting allocation. And there's ways we can rebalance our portfolio with trimming. When we trim at multiple price points, we reduce variance. So if we sell a portion of our position at $100 a share and then sell some at $120 a share, and maybe we sell some at $90 a share, then it really reduces the variance and doesn't lock us into one price point. There is one psychological advantage of trimming where if a stock crashes and has a bad result and we've trimmed at higher prices, then we've sold at much higher prices and we'll typically feel good that we sold at a better price than the current price. Also, with trimming, we can let our winners run, but still take profits. So it's really the best of both worlds using this strategy. There are some cautions around trimming I'd like to point out. First, when you trim, there may be tax implications, and you may be paying a capital gains or a capital loss depending on the situation. We also want to avoid wash sales and thrashing our opinion. What this means is sometimes somebody may trim a stock and then decide that wasn't the right choice and add it back right away, which can create a wash sale. And I would define thrashing as constantly going back and forth. So maybe one day we decide we want to trim, we add back, we trim the next day, we add back. And we want to kind of avoid that behavior. Now we'll review reasons we may want to sell a stock. And if you'll notice, this is a pretty long list, and it's hard to enumerate every possible consideration. But we'll go through some of the main reasons we may want to sell a stock. And the first one is the narrative worsens significantly. So if this was a growth story, this means the growth story may have ended. And now the company is not talking about growth, but they're talking about another potential issue they have. Many times after a company reports earnings, their financials can worsen. And this could be a company we invested in who was growing 50% year over year. And now in this latest report, they're growing only 30% year over year. Or the company may give really poor guidance going forward. And that's always something to look out for what the company guides for, because that can give us clues about where the company is headed. Sometimes I've sold a company because of competition concerns. And this could be because a new player is entering the market, or because I didn't do enough research and found out there's an existing competitor who might have a competitive advantage, or there may be a whole group of competitors I was unaware of and found out later. Competition isn't always a bad thing, though, as it can indicate a growing market. And another reason I might sell a company is I've just lost confidence or enthusiasm in general. Sometimes a leadership will change in the company where the CFO resigns or the CEO changes. And that's something important to look into to see if we want to sell on that news. There can also be financial issues such as filing delays or accounting problems, which can cause us to sell. Additionally, debt raises or share offerings that simply don't make sense to us can be another reason to look into as a reason to sell. The company may be raising the debt or the share offerings to make an acquisition, and we want to be careful of companies which make a lot of acquisitions in a short time frame or make a big acquisition that we aren't sure about. Sometimes it can indicate the company has trouble innovating with their own team or their own products. I wrote here we can sell if we learn something new about the company we don't like. And this is really another umbrella category because there's so many potential varieties of things that can come up. But if there's something we really don't like about the company that we discovered after we bought, that can be a good reason to sell. Another reason to sell is we keep forgetting we own this company or that it's in our portfolio. If we do the exercise of just writing down all the names of companies we own, and we keep forgetting to put that company down when we write down our companies, that might be a reason that we're not really enthusiastic or we just keep forgetting about the company. And it could make sense to reallocate to higher confidence positions. Sometimes a company may do something that crosses our personal ethical barriers. And this doesn't happen too often, but sometimes the CEO may say something, or there may be a product which really offends us or goes against our core values. In that case, it's okay to sell. And the last reason I have here is the total addressable market's too small. Sometimes we think this product may have huge potential, but then we learn that the set of customers they're actually selling to is quite small. And that can be a good reason to reevaluate and consider if we want to sell the company. One recommendation is after we've actually sold a company, we want to remove it from our watch list. We don't want to be focused on where the price is going if we don't own shares anymore. And sometimes what can happen is we sell a company and then we see it just keeps going up day after day, and we might get upset by that. But we're losing our focus on the companies we do own, and we'd prefer to be forward looking and not looking back. And keep in mind, we can always revisit a company later. So maybe after 2 weeks, we've cooled down after selling the company, and we can re-add it without experiencing a lot of emotion related to that. Now that we've discussed reasons to sell or reasons to trim, I want to look at some reasons to hold on things which could initially appear to be reasons to sell or trim. And the first one is that the price went down on no news. And I put an asterisk next to the no news one because sometimes insiders or a large group of shareholders may catch on to some announcement which is coming out before it's public. And that is rare, but it is something to look out for. Another scenario where we may just want to hold is on a short report. A short report which crashes the stock price is something to definitely investigate, but a lot of short reports are not based in factual evidence and they just try and crash the price without having a real bear case against the company. So most of the time, we're not selling on short reports, but they can be worth looking into. Sometimes when a company goes down in price, there will be shareholder lawsuits against the company. And 99% of the time, these are frivolous. I actually can't recall a scenario where I've seen one of these be legitimate. And most of the time, the law firm is just trying to collect people's money or sue the company. And it usually doesn't pan out to be anything. Although the headlines can seem scary when it says this company is being sued by this law firm, which sounds like a respectable law firm. Another reason to hold may be why we're trying to understand a bear case. We're doing more research and understanding what the counterpoints are to our company, but we're not ready to trim or sell just yet. We also want to hold through general market declines typically. And just because the market's going down and our share price is going down on our companies, it's probably not enough of a reason to want to sell or trim, as the valuation's getting better and there hasn't really been news or a specific company reason to sell. I want to get into specific examples of when I trimmed or sold companies. And we'll look at trimming first. So, AppLovin tripled in price over the course of 3 months in late 2024. At the time, AppLovin was my second highest conviction position, or my company B if we go to portfolio allocation. So I believe it was a 16 or 17% allocation, and it kept getting close to 25% of my total portfolio. And typically, I don't even like to have a company go above 20% allocation, but sometimes it happens where the company just rises so fast we can't really help it as we don't want to kneecap our winners completely. And as the company kept getting up to 25%, I would trim a little bit and make it more like a 23 or 24% position for my overall portfolio. A key concept here is that we want to be able to sleep at night. And that means we don't want to be nervous about a company. And what happens is if a company gets up to 25% of our portfolio or becomes 30 or 35%, then we have so much riding on the outcome of that one company. And if there's bad news about that company, we might start to panic because we could end up losing a lot. Our next example of trimming is related to a competitor. And this example is quite old, about 5 years ago, but it still sticks out in my head as a good example. The company Slack, which makes a workplace communication tool, had a new competitor with Microsoft Teams. When I first started researching Teams, it seemed like an inferior product at first. But now my thesis changed a little bit that Slack had been a greenfield opportunity and the field was starting to look a little more crowded. I did have concerns that Microsoft could run Teams at a loss for a long time, and Microsoft didn't need to worry about getting profitability from Teams. It became clear that Microsoft could bundle Teams for free with other products such as Office 365, and I decided to trim where I learned more about the competitive threat. I'm also going to use Slack as a sell example later as well, but I sold for a different reason, and I first wanted to look at why I trimmed this company before I sold it. Another example of where we may want to trim is when the narrative changes. And Supermicro was my company A, or top allocation position for a while. There was two separate times I trimmed Supermicro for narrative-based reasons. And the first time was because Supermicro got blocked on the quarter. Their supply didn't arrive in time. And on the earnings call, the CEO didn't have the same enthusiasm as previous calls. The narrative on the call switched to talking about inventory issues and shipment issues, even though management reassured investors this was a one-time blip. But the new concern caused me to trim some, and the CFO reassured that the shipment of product would go into the next quarter. The second example of when I trimmed Supermicro was on that next quarter, where the company had promised higher shipments. Yet on that new quarter, gross margins collapsed, and the gross margin went from 16% to 10%. Yet when the company was giving explanations for why this happened, it didn't seem to make sense to me. The company had explained their product mix had changed, and that caused the gross margin to go down so much. But I would have expected gross margin to go down maybe a few percentage points, but not go down from 16% to 10%. And my confidence in my company A was rapidly diminishing, and that caused me to trim. And I ended up setting my allocation to be more in line with my B, C, and D companies, or my second, third, and fourth companies if we reference the sample portfolio allocation. Now let's look at another trimming scenario where we're dealing with uncertainty. And this deals with AppLovin again, and I wanted to make this one as a separate slide. So AppLovin in 2023 was said to be hugely impacted by iOS or Apple phone privacy changes. Prior to this, I hadn't done a lot of research about how AppLovin worked in the iOS or Apple Store, and I wasn't sure of the initial implications of this story. I decided to trim a small amount while I learned more, because I was feeling nervous that I didn't understand enough here. As I was investigating the issue, I learned this iOS upgrade was not as big as I previously thought. While Apple was renaming their packages, the privacy changes were actually pretty small, and that resulted in my confidence going up a little bit. However, my overall takeaway on this situation was that AppLovin depended more heavily on iOS and Android decisions than I originally thought, and that caused me to trim a little bit here. Now we're going to get into some of the sell examples. And one thing that can happen with an investment is we learn a new fact about a company, and we find that fact to be very unappealing for our overall investment. And I had decided to invest in a company called ARM, and this started out as a medium confidence position. I'm guessing many people may have heard of ARM as they're in the AI hardware space, and their designs are used to produce a lot of different chips. I did a lot of research on the company, and I read their latest earnings reports and tech conferences. And the very next day after I bought into ARM, I learned that ARM is owned 90% by SoftBank. And I learned that from another investor, so that wasn't from my own research. But that fact was really bothersome to me because I felt like SoftBank may have an incredible amount of leverage over this company. I did go back and confirm that information myself, and it was right there in the S1 or the IPO filing. So sometimes what happens is we buy into a stock and everything looks great, and then we learn some fact which just completely nullifies our thesis. And while I thought ARM is still a promising company, I decided to sell the position based off this new information. And it's good to write down reasoning for why you sell a company. And my reasoning here was simple. SoftBank has too much leverage over this business. Let's look at a reason to sell a company, which I'll call the CEO meltdown. And if you remember before, Slack was a company that I trimmed because of competition concerns. Slack had an earnings call where the narrative changed significantly, and the CEO was really angry at Microsoft Teams. He claimed Teams was a copycat product, and Slack would be starting lawsuits soon. The story of the company suddenly switched to how unfair everything was, rather than focusing on the growth of the company. And the CEO had never been this angry or aggressive before. And I kept thinking, does this investment depend on legal actions now? I decided to sell Slack on this disastrous earnings call or narrative change. And some months later, Slack got sold to Salesforce at the IPO price. And this was really the CEO's last attempt to control his company before he was forced into selling it. Now let's revisit a company we previously trimmed that we're going to sell now, Supermicro. And this was related to accounting issues. So there was a short report that alleged Supermicro had some accounting issues. And I was planning to research the report because Supermicro was down maybe 5% on the short report. And it seemed like it may be worth checking out what they were saying there. Before I had a chance to even research the short report, the next day Supermicro announced on their investor relation page they would be delaying their annual filing. And that was a huge concern. And I'd already lost some patience with the company from their supply blocked quarter, and then they had their low gross margin quarter. This was the first time I could remember in a while where I was panicking because I owned a company. And I was really nervous, and that was a signal to investigate further. The delay in filing was already a red flag for me, but I decided to research the short report anyways. And Supermicro had a very interesting or weird relationship with a subsidiary known as Abelcom. And it seemed like the company could be self dealing or buying something and then selling it back at another price. It became a big concern that Supermicro might not be recognizing revenue properly. And lastly, I had to evaluate the tax implications of this sell because Supermicro was in a large amount of gains for me. And even though the price dropped a lot on this short report and accounting issues, I would still be paying a fair amount of capital gains tax on a large position. After doing my research, there were simply too many red flags to ignore, and I was so nervous about holding this company. It ended up causing me to sell my full position. And I do want to point out that on a previous slide, I had said to hold on bogus short reports. And this short report actually seemed to uncover something. Typically, most short reports are bogus, but in this case, it was worth investigating and it did uncover something real. The last example of selling I want to give is with the most recent company I sold for a customer concentration issue. The company Credo revealed in their latest earnings report that Amazon made up 86% of revenue in the last quarter. While the company had given incredible guidance on the previous quarter, they didn't mention about this customer concentration. And I felt that management should have alerted investors earlier because they definitely knew that Amazon was going to make up a huge portion of their revenue. One analyst pointed out that revenue dropped off for other customers, and management didn't have a great explanation except to say this was just the typical business cycle. I ended up selling on this thesis breaking change. And my original thesis was that Credo was selling to a lot of different hyperscalers and a variety of customers. And I want to point out we can always reevaluate in future quarters. If Credo is able to resolve this customer concentration issue, I could see potentially rebuying into this company. To summarize our discussion of selling or trimming, we want to trim when we're on the fence or we're unsure of our decision. And trimming is an effective way to maintain our portfolio allocations or to reach our target allocations. Trimming reduces the overall variance of growth investing. Trimming at multiple price points means that we don't sell all our stock at a single given price, and it still gives us room for our winners to run. We want to sell when our conviction has changed completely, and smaller positions can be sold easily, while larger ones require more thought on how to reallocate our funds. Nervousness on a position may indicate we should trim or sell, and we can always change our mind later. We should be continually reevaluating new information. And that wraps up this YouTube video. So hopefully this has given you some guidelines on when to sell or trim a position. And it's impossible to enumerate all the reasons we may want to sell or trim a position, but hopefully this gives you a good guideline for basis on when to sell or when to trim. And if you like the video, click like or leave me a comment. Thanks.